All right, everybody, welcome back to Legal Talk. I'm your host, John Mitchell, back with you again, bringing some good information that we can use. And this is another question that I've been asked. Now, we've been talking lately about the Dirty Dozen, right? So every year, you Google this, it comes right up. Every year, the IRS publishes a list of the top problems that they see happening, right? Any instances of fraud, any instances of things like tax evasion, problematic things that the IRS sees. And they issue this list as kind of a warning to folks out there, right? So that you can know that you know what to kind of steer clear of, right? So one of the things that happens, and it has made the Dirty Dozen list, believe you me, for several years now. And one of the things that they always have on the list lately is about micro-captive insurance companies, right? So let me just back up and tell you a little bit about insurance, all right? Just a few days ago, I wrote my monthly check to State Farm Insurance because, like a good neighbor, State Farm is there with their hand out, looking for that monthly premium payment, right? So now when I wrote that check to State Farm, they take that, they put it in their bank. Guess what? That $300 that I just paid State Farm, that is not income to them for tax purposes. So they are not going to claim that, and they're not going to that's not going to be income. That's not going to be taxable income to them when State Farm files their gigantic corporate tax return, right? My $300 plus the $300 for a lot of other people, right? Premiums that an insurance company gets are not income to the insurance company. So keep that in mind. That's an important point, right? Insurance companies are taxed in kind of a special way. They only pay taxes on the investment earnings, right? So insurance companies will take my $300 and hopefully I don't have an accident and they don't have to pay it out anytime soon. So they take that money and they invest it, right? And so when they invest that and make earnings off of that, that's their earnings. That's what they get taxed on, right? So keep that in mind. Now, let's say I have I have a bunch of restaurants, right? I did some tax work for a company a couple of years back. There's a group of investors. They had 16 restaurants, right? So let's say I've got my 16 restaurants and they're in different partnerships with different people, right? So I got 16 different corporations that own each location of the restaurant chain, right? So now I'm going to say, well, I'm paying a lot of money every month for insurance, right? I got to have insurance, maybe business interruption insurance. I got to have, insurance against thefts. I got to have fire insurance. I got to have workman's comp, right? And so what if I owned the insurance company? So what a micro-captive arrangement essentially allows you to do is you own the insurance company and you actually are able to pay from your businesses. So each one of my restaurants would write a check, let's say, to the insurance company, which I own, and so they're going to take a tax deduction for that. And so I get the deductions for all of these premium payments, but then my insurance company doesn't pay taxes on that money as income. So you see where this can get interesting, right? You can use this micro-captive insurance company to really just accumulate a bunch of money, basically tax-free, right? And if I ever shut the whole thing down and take the money out, then I got some tax consequences on that. Even that's going to be treated favorably depending on how I did things, right? So long story short, I can have a micro-captive insurance company that covers losses, potential losses from my other businesses, right? That can work, like I said, the example of the restaurant chain. That can work, like if you have a bunch of rental properties, you could insure your own rental property, right, with your own insurance company. And then a lot of times what they do, the micro-captive will go ahead and enter into a reinsurance contract. And so their loss is covered, but at a discount, right? And so they're playing the difference between wholesale and retail, right? But now part of what they do that gets people into trouble is they're going to say, well, I'm going to pay $10,000 a month in insurance premiums, based on the risk of an alien invasion, right? What if space aliens invade Earth and my business ends up poorly affected by that, right? And so and that is not too far outside of the realm of what people have tried to do. And so one of the things that the IRS looks at this carefully, and they'll say, well, is that a real risk that you're trying to insure against, right? And if it's not, there's going to be maybe disallowed. Right, you're going to get your disallowed deduction. You might get some accuracy-related penalties in there. So you got to be careful with that. And so one of the things is insuring against an improbable risk is what they call it. The other thing is greatly inflated. Right. Let's say I've got a business and State Farm is right now charging me $300 a month for my full coverage auto insurance for my 2 cars, myself and my wife. Okay, so now let's say if I've got a business and I say, man, I use my cars eventually, occasionally for business. What if I were to pay my own insurance company? And guess what? I'm going to not pay $300 a month. I think, now that I'm the insurance company, I think my insurance is worth $3,000 a month. All right, and so I'm going to pay that. And I'm going to take a tax deduction on the one business, and the other business, which is my captive insurance company, I'm not going to pay taxes on that money because it's premiums, right? So, but the IRS is not going to let that fly. That's going to be a problem because now I'm not charging market rates, and it's not what they call an arm's length transaction, right? And so that's going to, get people into trouble. And one of the arguments that also the IRS will use when they're trying to undo these transactions, they'll say that the transactions are not, they don't have a proper economic substance, right? So you got to make sure that all your I's are dotted, your T's are crossed. This takes planning, and you got to do it right and make sure that you don't run into trouble with the IRS and take deductions that you're not entitled to, and play funny business, right? So captive insurance can work, but you got to do it right. Okay, so that is, again, one of the things that the IRS warns against, dirty dozen. So be careful of that. Make sure you don't fall into that insurance trap. I am available for consultation. 713-333-0555 is my number. I'm here in Houston, Texas, but I can take tax questions from all over the United States. And my email, jmitchell@cctaxlaw.com. Thank you, everybody, for being with us on Legal Talk. We really appreciate it. Shoot me an email. Let me know you watched the show, and send your questions as well. I mean, your question might make it on the air, and I might do a segment about it. So thanks, everybody, for being with us on Legal Talk. I'm your host, John Mitchell. We're here on the Now Media Network, and we're happy to have you. And we'll be back next time with more Legal Talk.